This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright. As you will notice, I have no guest host today. Today on the program, we have Ben, who was recently on with us there from Brass Financial, but we brought him back on so fast because there's new capital gain rules coming out. So we got to figure out, what are these new capital gain rules? How are they going to affect commercial real estate? How are they going to affect us Canadians when we're selling stuff? So we reached out to Ben and said, hey, we know you were just on. I need you to come back on right now. We're getting inundated with emails, people asking us if we're going to have a guest about this. How do they work? So we reached out to Ben to come back and join us. But no Matt, no Adam, no Melissa today. I sent an email out. I put out there about the topics that we're talking about today, and all of them felt it was way over their head. They didn't understand capital gains in the first part. So I think they're all just scared. So today it's just me and Ben joining us here. So without further ado, let's get to our interview today with Ben of Brass Financial, talking all about the new capital gains laws. Enjoy, guys. This podcast is presented by Impact Commercial.
Impact Commercial, John, Alan, the team over there are fantastic. They've all been on the show.
They have, yeah.
Friends of the show.
Great guys.
Wealth of experience. They can help with all your commercial financing needs.
Whether it's owner-occupiers, land development funds, commercial investments, or multifamily, these guys got you covered.
And they recently obtained their CMHC correspondent lender status.
So for all your commercial lending needs, visit them at impactcommercial.ca.
That's impactcommercial.ca.
All right, today we're here with Ben Vella, Director of Brass Financial. Ben, how you doing today?
Good, yourself?
Good, thanks. Well, Ben, I know we recently just had you on a couple months ago now with regards to talking about accounting tips for commercial real estate, but we have had tons of emails and stuff through the social media channels and all stuff asking us about Canada's new proposed capital gains laws. So I thought, well, we got to get this topic covered quickly here. We'll date stamp this today. We're recording May 31st, 2024. The new rules are proposed to take effect June 25th. So we wanted to get this show covered now so we can get this out there. But Ben, before we get into that, for those people who didn't listen to your most recent episode with us, can you tell us more about yourself?
Yeah, sure. So I'm a CPA in Canada, and I obviously come from Australia, where I'm a chartered accountant there. I have run practices in both countries. My wife and I have settled down in Canada, been coming back and forth since 2007, and I have several investments, including an investment into a large general contractor business as well, and it's been a lot of fun. But yeah, tax is an ever-changing industry and keeps me on my toes.
And can I say recently, congratulations on the birth of your twins?
Yeah, thank you. Yeah, 3 and 3. So
yeah, 3. We struggled with one, and we always thought, like, man, I wonder how people with twins do this. So now I can ask a year down the road how it went.
Through sheer sleep deprivation, coffee, and you really have to love one another.
It'll all be. It's funny because mine are 8 and 6 now, and whenever they pretty much tell me to take a hike, I keep telling myself just 20 more years and they're moving out. Just 20 more years and they're moving out. So we'll see how it goes. But
maybe make 30 with the property market.
Oh yeah, I know. That's why it's like they're and then you both tell us like we're never moving out. I'm like, you're moving out. Ben, we wanted to have you on today because obviously there's been some new proposed capital gain rules changes to the capital gain rules here in Canada that will have impact on people who are buying and selling commercial real estate. Can you maybe first, before we dive into sort of what's proposed and what's the new, how does capital gains work now? So I'm an owner of a piece of real estate. Maybe I have it personally, maybe I have it in a corporation. I go to sell it. How do the capital gains rules apply currently?
So currently, since about 2000, it's been 50% of your capital gain will get included into your taxable income. So if you're an individual and you have that income, let's say you make $500,000 as a capital gain. You bought a property for $500,000, you sold it for $1 million, obviously after expenses and selling costs, then you have that $500,000. Well, historically and up until June 24th, when you put your tax return in, it will instantly halve. So basically only $250,000 will go into the tax return and you'll pay your taxes on that $250,000. It's a bit of a misnomer. There's no separate capital gains tax. It's included into your personal tax. So if you have income of $100,000 and a capital gain of $250,000, it's going to be that your total income is $350,000. It's just treated differently for tax purposes.
Gotcha. So,
and the same basically applies for if you hold it in a corporation as well.
Gotcha. So essentially, is if I'm making $100,000, I'm going to be taxed as an individual in Canada on my $100,000 in income. I now have this capital gain. My first 50% of the $500,000, the $250,000, that goes in my pocket tax free. The second $250,000, that goes on to my tax return. Now combined between personal and my capital gain, I make $350,000. That just pushes me into a higher tax bracket overall. Is that correct?
Correct.
Gotcha.
Yeah. So then we have a stepped tax system here. So, as you earn more, you pay more.
No, it's lovely. It's absolutely lovely how it works. So obviously the Liberals have come out with their federal budget that they do every year. We're heading into election year, obviously, so you can understand, kind of how they're going to derive where the money's going to get spent in order who's going to vote for who. But part of that was a increase to the capital gain. So right now, just to recap, as we just did, the first 50% of a capital gain is tax-free, money in the pocket. The second 50% goes onto my personal tax return, thus pushing me up into a different category. We've got some new proposed rules. How do those new rules come into play, and what are those new rules?
Yeah, so basically what they're doing is they're saying instead of 50% being included into your tax return, they want to move that to 2/3 or 66.6.
Oh, excellent.
And they want
excellent.
So basically, so that $500,000, it's a significant increase, right, in what would be your capital gain. So it's definitely something that needs to be considered. And right now, there's a lot of reorganizations, especially within corporations or holding companies, as well as deemed disposals by individuals. So people are looking at how can I transfer, what can I do to save the money, especially if they were already considering doing that. So it does come into effect on June 25th. So at this moment, legislation hasn't been passed. However, it's always best to act as if it will be, because they could try to rush it through, right? It's May 31st. They've got until June 25th. So it will. Everybody is operating on the assumption the law will pass and come into effect.
So if I take those numbers and kind of break them down, so if I take my same $500,000 gain I have, previously $250,000 is mine, $250,000 is taxable, or 50% of my total gain. With the new rules and that $500,000 capital gain, it's 2/3, 1/3. So that $250 that went in my pocket, now that's been reduced to $165, or 1/3 of my $500,000, leaving me 2/3 or $335,000, which is now taxable.
Correct.
Oh, this is lovely.
Yeah. So,
lovely.
So it's a significant increase. So it's a good cash grab.
I know it goes on a personal income, and that, as you said, it steps up on the tax side of things. So that amount could change. But is there kind of like a rough number? If I was an individual and I'm making $100,000 and I'm going to sell a property, and I know with these new rules, 2/3 of that property is subject to taxes. So in this case, $335,000 is subject to tax. Is there a percentage I could kind of like mentally allocate, thinking, okay, of my $335,000, I'm going to pay 25% of that or 50% of that? Is there a vague number that an individual could potentially try to peg if they were just trying to figure out numbers on the back of a napkin?
Yeah. So if you're earning 100,000, I would say that you're easily going to be showing that I would be putting 50% aside, just simply because the first let's call it 84,000, especially in BC.
Yep.
It's basically once you get over that amount, you're going to be hitting 53.5% tax rate.
Oh, great.
So yeah, I would definitely be just saying, look, 50% will keep you in the clear.
So now that 50%, so previously 250,000 goes onto my tax return. Of that, 50% arguably is, or 125 is taxes I'm going to pay. Now 335 goes onto my tax report, my thing, of which 50% of that 335, and I'll be honest with you, my math isn't that good in my head to quickly chop that in half, is going to go on. So I'm seeing a significant increase, $30,000, $40,000, $50,000 potentially more in taxes paid on that same sale.
Yeah. So what will happen is, because the inclusion rate has diminished, so you'll get about $166,000 that'll be tax free instead of the 250.
Okay.
And then the difference will go. So you'll have about 333,000, 334,000 in tax, like in taxable income. And then you'll pay tax on that. So if you did earn that 333,000, it would be a significant increase in taxes, right? So
I'm pulling the calculator out here while we talk here. So I think I got these numbers. So previously I was making 250,000, of which 50% arguably is probably taxable. So that's 125. Now 333,000 or 335,000 is now taxable at 50%, of which is 166,500. So my increased tax on that potential was 41,000 and change.
Yeah.
Oh, excellent. I've never felt the need to want to drink when we're doing these shows, but I think this, if we're ever going to start drinking during a show, this would be it to try to get through this. So I guess the question then becomes, individuals hold property in this country. Corporations hold property in this country. Is there any difference between the holding position of it and the taxation of the capital gains moving forward?
Yeah, so individuals get a little bit of a break in comparison to corporations. If you've got a holding company, you pay, or you will have the 2/3 inclusion coming straight from the first dollar of capital gain, in comparison to what is the individuals, where they say the first 250,000 will be at the original 50% inclusion.
Yep.
And everything thereafter will be the 2/3.
Yeah, I was gonna say, is there a benefit to holding it individually versus corporately from a tax perspective, besides the obvious that you just stated? Is there other benefits in holding it in a corporation versus an individual besides like the legal stuff?
Yeah, holding it in a corporation keeps it safe. There's also the ability to, depending on if you're operating a business and how you operate that business, as well as its profitability, that you could look at a small business deduction and having the ability to actually keep the income within that holding company relating to that property, in BC, the 12% tax rate. So there is some benefit to holding it within the company in comparison to holding it individually. The other benefit that you have is, although you get a higher tax rate, if you're accumulating wealth and accumulating rental income and therefore cash into your holding company, you can then redeploy that into other investments. Yes, you're paying a higher rate of tax, but if you're paying a higher rate of tax personally, again, you can split that out so that you're not paying the tax up front. You're actually able to pay it and then defer that personally to a point where your income falls, right? So you might be taking a fantastic salary out of a very profitable business.
Yep.
You've got that property that's renting. All of those circumstances may allow you to actually say, okay, well, I'm just going to keep reinvesting it, build my nest egg up out of my holding company. And then at a time when I decide to retire, that's when I'm going to start putting a dividend through to myself.
Okay.
So those are some really important elements to consider. But yes, in terms of the legislation, if you're not looking to sell your property anytime soon, it's really and again, politicians and parties and they'll do things to entice people to vote for them and not. And that's really what this is, right? So you never know what will happen in future, but for right now, if you're selling, within the next few years, you may want to consider, well, how do I structure this so that I can actually take a benefit of it? And there are certain things that you can do from a corporate level to basically trigger a capital gain, recognize that tax, and move on, right? And especially if you own shares this also applies to shares. It's not just property. So it also applies to if you own shares in a business, you may want to recognize that capital gain as quickly as possible by conducting, an estate freeze or something like that, and just bring that market value up. So now you've got the 50% inclusion, and now you've reset your market value for those shares.
This sounds like a whole other episode.
Yeah, it gets super complicated. So, but in terms of the benefits, they're trying to equalize and make it fair. So what they're saying is that the individuals really, they don't want to be penalizing them too much. They're going after what is considered, in their minds, considered the wealthy, which are the people that have these holding companies.
So how does this scenario play out? So I own a piece of property in a holding company. I sell it, and let's say hypothetically I have a $500,000 gain. I make $1 million, or so I have a $500,000, so I cap gain, or subject to cap or profit. Profit. Sorry, coffee hasn't kicked in yet here. Profit. But I have in a corporation. That corporation is going to pay the capital gains as a company, or do I pay that capital gains when I extract that money from the corporation to me personally?
Well, the company will pay the capital gains first.
Okay.
So if it's $500,000 of profit on the sale, then it'll be, the $333,000 on or after 25 June.
Yeah.
It'll be the $333,000 that goes and is taxable.
Okay.
Of which, let's call it that you're going to have a tax bill of about $160,000.
Okay.
And then there's another concept called a capital dividend account, which is where that $160,000 goes.
Okay.
That is still tax free.
Gotcha. So I'm not double dipping here by the company paying and then me paying. I can then extract that money out of that company into my pocket because the corporation paid
capital dividends, and through not only capital dividends, but also an eligible dividend. Because just so everyone's aware, there's two types of dividends. Eligible dividend just basically means that it's had a higher rate of tax placed on it.
Okay.
So that you would declare an eligible dividend and a capital dividend to try and take out the money that was tax-free and the money that was, if you wanted all of it, and the money that was subject to tax.
Gotcha. Okay, I follow. That was going to be my next question when you talked about different dividend classes. I'm like, how does that benefit either one? So now knowing that this is pretty much all but done, it sounds like coming down the pike here at us on June 25th, is there anything now, and you touched on it just a little bit, maybe you can elaborate on it. Is there anything someone could do now besides the obvious of sell the property and close it before the 25th? But is there anything someone could do if they're holding their property past that date that they could do now with regards to the current legislation before new rules come in place after to maybe try to minimize future capital gains?
Yeah. So, I mean, say for instance, you own an investment property, a rental property with your spouse. You may decide, what, I'm the higher income earner. I'm going to transfer that to my spouse. Now, obviously, there's, you have to consider different taxes, not only, property transfer taxes and the rest of it, to make sure that you cover those appropriately. But you may decide to actually transfer that property to your spouse and almost like a gift and recognize that income. Obviously, it has to be at market rate, and there's what they call attribution rules, which tries to push the income back onto the party if it's not at market value, and there's a range of circumstances, but that's one of them that you would definitely talk to your accountant with. And that the other one is looking to actually place it into a holding company. So you may say, okay, I'm going to do an asset rollover, and and instead of normally when most accountants do rollovers, it's to defer the tax. You would just trigger that tax. So you may set up a holding company and get that process going and push it into a holding company and to conduct that sale.
Got it. So I'm kind of doing that now to trigger the capital gain on the 50-50 portion of it versus the 3366 we're going to have after June 25th.
Yeah. So, let's, for instance, if you're already in the highest tax bracket for, individual taxes, you may go, well, you know what, I'm going to just I'd rather pay the tax now, and at 50%, I'm going to keep this property for decades to come. It's going to be generational. I'll put it into the holding company and I'll save myself some money down the road when it is eventually sold. That's definitely one thing that you can do.
Yep.
Obviously, there's transfer taxes and all the rest of it, but again, it could be a situation where that could work, especially if you've held that property for a long period of time and there's already a significant amount of equity there.
Now, how does, thinking about international investment into Canada, because we do have a lot of, I know I'm not saying foreign buyers, I don't want people to draw that conclusion, but there's a lot of companies and institutions and REITs and corporations that invest in commercial real estate, not only in BC, but throughout Canada. How does Canada stack up from a capital gains perspective, say, versus the US or maybe Europe, if you know those numbers there? Thinking about kind of these companies that have holdings throughout the world, are we almost kind of making ourselves less attractive to these investment companies because of the increased capital gains versus some of the counterparts that they might be looking at?
Yeah, I mean, it is pretty high. I can tell you that in Australia, you get in Australia, it's called the 50% discount. So you'll get 50% off the capital gain, which is basically the same as the inclusion rate, so that you don't have to worry about that. It doesn't necessarily apply to companies, so that can be a massive difference as well. So for those companies that have multinational, and operate across jurisdiction, multiple jurisdictions, they'll always have that issue.
Yep.
But I would say Canada's it's not that bad. It is a significant increase, but it's really to target the people that have been speculating, as well as the people that buy properties every few years and then sell them, right? And especially in the market that's been happening, I guess if we say within Ontario and BC, that has been a very, very large amount of transactional work, and I'm sure that a lot of lawyers and notaries will attest to that. Yeah. So it's just a matter of the government's probably a little bit late, but they're just trying to pick up on those transactions.
Well, I can, from the brokerage level, I can neither confirm nor deny if buyers and sellers are trying to move dates around to try to get in before this new proposed capital gains part. So that I would never comment on to know, but I'm pretty sure the activity that the lawyers are doing between now and June 24th will probably speak for itself.
Yeah, accountants are also incredibly busy. There's a lot of restructures and especially on the sale, like just the share side as well, is quite high.
But we've run into situations where, again, like you sort of spoke about these generational type properties where, people had purchased these properties for, I want to say, almost nothing compared to today's prices. And it's been sitting in a family for years, if not decades. And now the family's looking to dispose of the asset, that there's a mad scramble right now where you're talking properties that are probably in excess of $15, $20, $25 million that are selling, that there's a tremendous difference to them June 24th versus June 25th on the capital gain side of it, that you're hearing a lot of hearing rumors of a lot of people, or not people, but transactions that are trying to move dates up or whatever it is for these rates. And then some of these buyers are also getting a bit of a discount to do that because they're sharing in the gain if these things can move.
Yep, correct. So there's benefits on both sides of the coin.
Is there anything else? Obviously, we touched base on the capital gains here, and you probably follow the federal budget on the accounting perspective a lot more detail than we do. So, Ben, is there anything else in the federal budget or the proposed federal budget that would have any impact on commercial real estate in any way, positively or negatively?
Great question. In terms of the commercial real estate, I don't necessarily believe that there's going to be anything that will push directly on it. Obviously, the capital gains inclusion is going to be the biggest mover. However, if you've got people that are in property development, especially in residential housing, there has been several, pushes by the government and changes and grants available to basically allow for larger abilities to obtain CMHC for these developments, and you have to hold them as investments. But the little known fact that you have the ability to develop a property, let's say you put 5 townhomes on it, you could, as the owner of those properties, could actually obtain 95% lending, so long as that you're building a house in an area where there is, a housing crisis, that you are unable to, that it's affordable housing, and you meet certain criteria, that you could actually develop that property. And although it's commercial in nature, so you would normally have to operate as if it was a commercial premises, the down deposit is much higher. Construction fees are, obviously are higher. All of that basically turns into what would have been a residential component. So there are some benefits that the government are offering to try and deal with this crisis and this issue. So if you do know people within the, I guess, residential development side of life, especially in BC where it's hitting in Ontario, that is definitely something that they can look into, and there's a lot of opportunity there.
Excellent. Well, Ben, we do appreciate you taking the time to join us. No end. We're going to give you a break here. We're not going to force you to do our 6-pack lighthearted questions. So we just had you on, and I'm pretty sure all those answers haven't changed since then. So Ben, how can our listeners find out more about what you're doing over at Brass Financial if they want to get a hold of you for any accounting work or questions?
Well, they can go to the website, send me an email, or give me a call. Happy to always help people. That's why I'm in business, helping others. So and the one thing that I would just leave them with is don't leave it to the last minute, because your accountant will probably cry. Your lawyer will say it's impossible. And the government will just say, thank you very much. So definitely, if you haven't looked at it now, start looking. And it's not just for property, it's for shares, it's for, any kind of investment that you currently have. Talk to your investment advisors, see what's long game, if you've got any shares in, large corporations that, I'm going to take some money off the table, we'll reinvest after the 25th.
Well, excellent. Well, Ben, thank you once again for joining us. Again, it feels like it was just happened, but thank you once again for joining us today to break down all the new proposed capital gains rules in Canada.
Yeah, no problem. Thanks
Excellent.
for having me.
Thanks so much, Ben. Take care.
Thank you.
There you have it, folks. Our interview with Ben Vella, Director of Brass Financial. Always great having Ben on the show. Broke out a lot of the new proposed capital gain rules. Also kind of opened up a lot of people's eyes, I'm sure, with this potentially how much of an increase it may be. As always, when these things transact right now in the short term, there's definitely going to be some pushback from sellers because they're obviously thinking, oh, I don't want to pay more money. But what's going to happen as we slowly filter out into the latter part of 2024 and into 2025, the cost of business will just sort of bring itself to the table. And then that's will be the cost of business in BC when selling commercial real estate. But obviously, there's a large amount of gains a lot of people are dealing with. So you'd rather pay a little bit more tax and have more gains and probably not really have any gains to start with. So for those who want to reach out and talk commercial real estate, you can reach us anytime over at William Wright Commercial through our website, williamwright.ca, where you can sign up for the latest and greatest. You're welcome to send me an email anytime. Love hearing from listeners, Cory@williamwright.ca. Or you're welcome to call our head office in Vancouver, 604-428-5255. Let us know what you're looking for, and we'll put you in touch with any of the agents throughout the province who can best service you. Thanks for listening, guys. Next week, we'll be back with another great episode. Take care.
Subscribe today.